Thanks for clicking. The Canadian dollar could move higher than that of the US once the Federal Reserve restarts quantitative easing on US debt woes. This according to my interview with Peter Schiff, Chief Economist and Global Strategist at Euro-Pacific Asset Management. Schiff is well known for predicting the 2008 financial crisis, while others were downplaying the writing on the wall.
How do you put together all this gloom and doom? What data tells you this, Peter?
Well, aren't you looking at the news reports coming out of the mortgage market?
I'm in the middle of it, yeah.
He was also warning in 2020 and 2021 that inflation would indeed be the result of all the money printing. Fast forward, and as we'll see today, Schiff is now predicting major problems on US debt, which he says could in fact lead to rate cuts, but not the good kind. As such, I wanted to speak with Schiff about what Canadians should be looking for from the US going into 2024, and how US debt problems will affect our own central bank policy and our own inflation rate. There is a lot of interesting stuff in this interview, and I'm going to be unpacking it next week, and we'll also be covering Bank of Canada Governor Tiff Macklem's speech on Friday. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. All right, so we have with us today Chief Economist and Global Strategist Peter Schiff, well known for predicting the 2008 financial crisis, also well known for predicting the inflation resulting from the money printer in 2020. Mr. Schiff, I want to thank you for being here today.
Oh, thanks, Mark, for inviting me on your program.
Definitely. I do want to get right into it, especially in light of the U.S. inflation data that just came out. I know you're skeptical that the Fed can get inflation back down to 2%. But from what we hear in Canada at least, inflation's just about kicked and rate cuts are around the corner. So I guess my question is, are we out of the woods?
Well, look, it's possible that rate cuts are around the corner, but not because inflation has been kicked. It's just because the economy is so indebted that the debtors, in particular the government, can't afford to pay the higher rates that would be a necessary part of reversing the inflation that the central banks created, particularly here in the United States. But no, I mean, inflation, the way they measure it, is not going back down to 2%. In fact, even when they measured it below 2%, it was above. They just weren't accurate in their measures. And those measures are still understating the true rate of inflation. So if the government claims it's gone down to the low threes, it still probably means it's at least 5 or 6.
So, but you think they're going to still cut rates even with inflation elevated at 3, 4, 5, or 6?
Yeah, I mean, they only became concerned about inflation being too high when it became a political issue, when it became the public's biggest concern. And of course, that became a concern for the politicians because they're looking for votes. But once there are larger threats that the Fed perceives to the system, such as the insolvency of the federal government, the collapse of the banking system, tremendous losses as the financial bubble pops, then the Fed's going to be more concerned about that.
Right.
In fact, that's why they created all the inflation in the first place. I mean, it's not an accident or a coincidence that the Fed and other central banks spent years deliberately trying to raise the inflation rate. They did that by creating inflation on purpose.
Right.
And so now we're experiencing the consequences. There was a long lag before it really showed up in a big way, but now it's here. And we're just getting a small taste of the inflation that's coming.
And I think I've seen you say this before, that the inflation that we've seen over the past few years was largely a result of the low rates over the past decade, and that we still have more coming over the few years ahead. Am I right on that?
Well, not just the low rates, but all of the money supply that those low rates helped produce. The U.S. money supply, has more than doubled during the QE era. And so, prices should double. Now, there's been some productivity increases that might diminish that, but, we still have a long way to go for prices to catch up to the inflation that's already been created.
Right.
But that ignores the inflation that's about to be created, because when the Fed pivots back to QE, because it becomes the only buyer of U.S. Treasuries, so that rates can stay at a level that the government can pretend to afford, doing so by definition just increases the money supply more and creates additional inflation.
I'm glad you brought up the Treasury auctions because we did see a few weak auctions this week, and we've talked about it quite a bit on my channel. So I'm wondering, is that going to be the trigger of the Fed pivot? Is that going to what brings them back to QE as a failed auction?
Well, I mean, they may not let the auction fail because they may step up to prevent it from failing. But if you look at the schedule of maturing Treasury debt in 2024, I think it's close to 10 trillion of the $34 trillion debt that matures. Then, in addition to that, the government probably has to borrow another 4 trillion. We seem to be adding $1 trillion a quarter. That's the pace that we're growing the national debt right now. And so if we have to add 4 trillion next year, 3-4 trillion, let's say, plus almost 10 trillion in rollover debt,
Right.
we're going to be auctioning off 13 to 14 trillion worth of treasuries.
Right.
Now, what are the odds that there is enough demand for all those treasuries? I mean, I don't think it's going to be there.
Right.
I think that a lot of the owners of those treasuries that are maturing are not going to want to roll them over. They're just going to want their money back.
Right.
And I don't think it's going to be easy to find new lenders that want to buy that paper at a rate that is affordable to the U.S. government. And so, yeah, I mean, they're going to go back to QE. That's going to be more significant than what they do with rates, I think, is going to be the return to QE.
So the Fed has to step in to buy up all these treasuries that the market doesn't want, that there's not enough liquidity out there to buy. Then what happens? What happens once the Fed steps in? Do you think there's a market reaction right away?
I would imagine that the dollar would fall,
Right.
gold would rise, and other commodity prices would rise, and that would put more upward pressure on inflation in the U.S., on trade deficits in the U.S. That would also undermine GDP in the U.S. So I think it's going to have some very negative consequences for the economy. And, also what happens next year, I think in March, is that facility that the Federal Reserve established to bail out all the insolvent banks, it was temporary.
Right.
So in March of next year, the banks have to take their underwater collateral back and repay the Fed. Of course, They can't afford to do that because the only reason they're not bankrupt is because the Fed took their bad debt off their hands at par. So obviously the banks can't take that bad debt back. They'd be immediately insolvent.
Right. Yeah, I think they called it QE by stealth back then.
Yeah, and it wasn't even that stealth because the Fed's balance sheet ballooned by $300 billion in a single week.
So do you think the Fed will just re-extend?
Well, I think they're going to have to. I mean, first of all, what choice do they have? I mean, obviously they have a choice of doing the right thing, but we could pretty much rule that out because they never do the right thing.
Right.
And, it's going to be an election year by March. I mean, now you're a lot closer. You're deep into primary season. Not that, Biden is really, well, he has challengers, but obviously the establishment and the media are not recognizing those challengers. But who knows? Maybe by then they might. But, we're going to be, half a year away from voting.
Right.
And so we know from the past that despite what they profess to the opposite, central bankers are highly political. And it doesn't matter what party it is. They favor whatever party has the White House. Doesn't matter, Democrat or Republican. The central bank tries to help reelect the incumbent party.
Right.
Because it wants to be nice to the president that appoints all these guys and that can reappoint them. So it's a very cozy relationship that's hardly independent, unfortunately. And so given that, it's hard to think that the Fed is going to do anything in a presidential election year that is going to cause a financial crisis.
Right. So that's not going to be the time for the Fed to hang tough.
No,
Right.
no. They're
Okay.
going to ease up and unleash more inflation.
Right. Okay. So the U.S. deficit, as you said, is growing by about $1 trillion per quarter by some estimates. After a while, that adds up to real money.
Well, that's
And
not an estimate. I'm just like looking at the national debt, right? You can
right.
see that. And I just watch like how long it takes for each trillion to be added. It's like it
Right.
happens pretty quickly.
It's especially
Yeah.
since the summer, isn't it? Yeah. So the Fed has to step in because no one wants U.S. debt. The market reacts. We see the dollar go down, gold goes up. What happens for the rest of us? We have a lot of Canadian viewers on this channel. What's that mean for us, for our central bank, our policy rate, our inflation?
Well, I mean, I think the central bank in Canada pretty much made the same mistakes that the Fed did.
Right.
Interest rates were kept low, and money supply expanded up there. So it's the same consequence. In fact, it's interesting that when, let's say the Republicans in the U.S. or anybody, when they go to blame Biden for inflation and blame the government, their response is, well, I mean, there's inflation all over the world, so that shows it's not our fault, right? It's a global problem. It's not a U.S. problem. Well, the faulty reasoning there is, number one, we exported our inflation to the rest of the world. We made our problem their problem, but also the rest of the world made the same monetary policy mistakes we did, the same fiscal policy mistakes we did. So it makes sense that they're suffering the same consequences that we are if they made the same mistakes. So that doesn't let our government off the hook, because the European government, is also complicit in the same thing. So yeah, the Canadian government did it also. But I think what Canada has going for it is that there are a lot of resources that the Canadians have relative to their overall GDP. And so in the type of inflationary currency crisis that I believe is coming, that could present an opportunity for Canada, because I think a lot of what Canada has is going to be revalued sharply higher. Particularly, let's say it's gold and other silver resources, and so that will help cushion the blow in Canada.
So it could help prop our currency up a little bit relative to that of the U.S. because of our resources.
I expect the Canadian dollar to move back above the U.S. dollar. I mean, it was above the U.S. dollar at one point. It didn't stay there very long, but it was. But I do expect that to happen again. In fact, it could end up moving considerably above the U.S. dollar. But that doesn't mean that the Canadian dollar is going to gain real value. In terms of gold, the Canadian dollar is going to keep on hitting new record lows against gold, but it could gain against the dollar because it's all relative. The dollar just loses value faster than the Canadian, which is the opposite of what's been happening. Both the Canadian dollar and the U.S. dollar, in fact, all currencies have been losing value. I mean, gold actually made a record high in dollars a couple of weeks ago before backing off. But before making a record high in dollars, it had already made a record high in just about every other currency.
So gold, and you see gold being the new reserve currency once all of this happens. You think that the gold's going to pop right back up? I mean, I know it hit $2,000, which is quite possibly a support point, but you think it could go a heck of a lot higher once the Fed steps in?
Yeah, I do, and it's not a reserve currency because gold is not a currency. Gold's actual money. Currencies were created, to make it easier to use gold. They were created as a substitute for actual money. So money, by definition, has its own intrinsic value. So the intrinsic value of gold is that it's a precious metal that has all sorts of uses. And so that's why people want gold. Paper money, currency, doesn't have any intrinsic value. There's nothing you can do with it. But if you back it by real money, then the currency derives its value by the money that's backing it up.
Right.
So that's really the difference between currency and money. Money has value on its own. Currency only has value because it's tied to money.
Right.
And can circulate more efficiently than money. The same thing would happen to cryptocurrency. If a cryptocurrency were backed by gold, then that cryptocurrency would derive its value from the gold that's backing it up. So that's the problem with like a Bitcoin. Bitcoin has nothing of value backing it up. It's just like paper. It's like the dollar. It's backed by nothing. It's just, itself.
Right.
Some people confuse that. They think, well, the Bitcoin doesn't have to be backed by anything because the supply is limited. Well, if you have a limited supply of something that's worthless, that doesn't give it value.
Yeah.
And it's not really that limited when there's 2.1 quadrillion Satoshis. There's a lot of Satoshis.
We've got a lot, yeah.
Big number.
Okay. Yes. So but do you think gold will now be backed? Will be the backer of these fiat currencies? Is that what we're moving to, like back in the 70s, pre-70s?
Eventually, that has to happen, because how do you end a currency crisis? You have to introduce something to change the game. You have to introduce something to reinstill confidence that's been lost.
Right.
And reintroducing gold would be something that would work. I don't know what else would work.
Something it does seem that gold is becoming more widespread. I know from what I've read, China is buying up gold, as is Russia. So it does seem as though there's some movements out there to increase the reserves of gold.
Yeah, well, all the smart central banks are buying more gold. They can read the writing on the wall. After all, they're helping to put the writing on the wall. So they're writing it. So they certainly should know what it reads.
They know what they're doing, give or take.
Yeah.
Yeah. So moving back to Canada. So are you of the opinion that the Fed it's going to be next year that the Fed has to intervene? And if and when they do, immediately for Canada, you think our currency will fall as well? Is Canada going to have to restart QE as well? I'm just wondering, what are the direct effects?
Well, we'll see. I'm reasonably sure that the Fed will restart QE next year.
Okay. And will that
we'll see what happens in Canada, but I think the Fed will do it.
And will that be accompanied by rate cuts? Do you think we're going back to zero along with the QE?
I think that QE is more likely than the rate cuts.
Okay. So
but
QE,
the market is expecting cuts.
Yeah.
And the Fed generally tries to deliver what the market expects. So I wouldn't be surprised if we got some cuts next year. But I don't think we're going to get the type of cuts, the magnitude that people might expect or hope for. I don't think the Fed is going to be able to go back to zero. They could, but I think the inflation that would, unleash would be so immediate,
right,
and so dramatic that the Fed is probably afraid to go there.
So they're going to move slow. I know the markets are predicting 125 basis points. You think it'll be less?
Well, no, that would be slow. I think the markets would hope that the Fed would go back to zero. If we go, again, those cuts are based on a soft landing, like we're not even in recession.
Right.
So, we start hemorrhaging jobs and the unemployment rate is 5%, 6%. If the economy is clearly in recession, all the pressure is going to be on the Fed to go back to zero.
And is that coming?
That's what we need. It's like when you're a heroin addict and you've got this big addiction,
right?
And then all of a sudden, you go into withdrawal, you need some heroin. You can't go back to just a little bit of heroin when you're used to a whole lot of it.
Right.
So small amounts of stimulus don't work anymore, or not that they ever really work, but to get the effect, the Fed's going to have to go all the way down to zero. In fact, they may have to go negative next time, which they never even did, in real nominal negative, like they did in Japan and they did in Europe.
Right.
That might be where they need to go, which is an impossible destination, especially when you got the reserve currency. You can't put a negative yield on the reserve currency.
Well, exactly. What would happen then if they did?
Punishing anybody for holding it, right? Hey, if you're going to hold our currency as reserve, we're going to punish you.
Yeah,
You know?
it won't be worth nearly as much in a year. Yeah.
Yeah.
Wow. So, and you think that's possible that the Fed goes negative? And I agree with
No,
you.
no,
They
no.
have
I think they would have to go negative to
okay,
give a bigger dose of stimulus than they did last time. But I
right.
don't think they can go there, because, I think it would be too big a disaster.
So, what's the end game? How's this work out? If they
Well,
can't
the
go
end game,
negative,
well, the end game is, much higher inflation right
right?
away, maybe hyperinflation. I don't know, just a lot higher inflation. And then,
Okay,
then the Fed is going to have to make a real choice.
right,
Is it going to continue this to the complete destruction of the currency with hyperinflation, a la Zimbabwe? I mean, is it going to be like that?
right,
Or is the Fed going to say we can't do that? And therefore, causing a financial crisis, forcing governments to default or forcing, these huge losses in the economy is better than wiping out the currency completely, and destroying its value. And but it's going to be like two really bad consequences that they're going to have to choose from.
right.
So there's no way out of it. It's just the lesser of two very bad evils that they're going to have to decide between.
And you think they'll pick the currency?
I don't know. They may not. I mean, I think they're going to sacrifice it as long as they can. So I think they're going to give up inflation. They're going to give up that fight. They're
Right.
going to let inflation get worse. They will, they'll make that deal with the devil, provided they think that, it's not like fatal,
Right.
But, and they have a lot of hubris. They think they can probably get away with this, but it won't. It'll just kind of get out of control.
Right.
But when it's obvious, like let's say inflation is at 10% a month, I mean, so we're talking, 100%, 100, whatever, I mean, it's really bad and it's going to get worse, right? I think at that point, right, once it gets that bad, then they might do something, but they may not be able to. There may be no political will to do it. But look, the people finally get sick of it. Look what they're doing in Argentina. They just elected a libertarian.
Yeah.
As a president. I mean, they're the poster child for inflation over there. We'll see if he can do anything about it, But it's at least it shows they're sick of it, and they're willing to elect somebody, who's, potentially can put an end to it or try to.
Willing to try anything.
Yeah.
The people, yeah. I know your time is limited, and so I just have one last question. Going into 2024, obviously all eyes are going to be on the U.S. What should we be focused on? What's the number one or two issues that Canadians should be looking for coming out of the U.S.?
Well, I think you really want to focus on the bond market to see a renewed breakdown in the Treasury market. Watch the U.S. dollar price of gold that has been, stuck in this range. It did, again, made a marginal new high above 2,100, but ran into some additional resistance. We need to get rid of that overhanging resistance in the market to really allow it to break to a much higher level.
Right.
Watch the dollar, watch the exchange rate. I think that's also important. Watch for a major break in the dollar down. Hasn't happened yet. Dollar's been kind of trending sideways. So it's not going up. It's just not really going down yet, but I think it will. So I think you watch the foreign exchange market, watch the bond market, and watch the gold market. I mean, those are the real tells. I don't think the equity market is that important, or cryptocurrencies or any of that. I mean, those are the ones that you want to focus on for signs of an imminent collapse.
Okay. Lots to look forward to. So look for the bond market, look at the Treasury market, look at the currency next year going into 2024. Mr. Schiff, I want to thank you so much for joining us today on this channel. And gold, of course, gold, over 2,000.
Well, it's got to be over. It's got to be a little bit more than that. It's got to be over 21.35. Who knows? We need to see some kind of major move up. Move. Several $100s.
That's going to be the writing on the wall.
Kind of like breakout. Yeah.
I gotcha. Okay. Well, thank you so much for joining us today on this channel. We really, really appreciate it, and I hope you have a good rest of your day.
All right. Take care, and good luck building the channel up.
Thanks so much.
Bye.